March 14, 1989, Phoenix, Arizona, 6:47 in the morning. Federal agents surround the offices of Lincoln Savings and Loan. They're not here to stop a robbery. They're here to stop one that's already happened. Inside, executives are shredding documents, 23 floors of filing cabinets being fed into industrial shredders for 18 hours straight. That's approximately 46,000 pounds of evidence being turned into confetti. They're destroying evidence of a theft so massive it would bankrupt most countries. But it's too late. Here's what they were hiding. While Charles Keating spent $4 million on a luxury yacht with marble bathrooms and gold fixtures, an 82-year-old former nurse was eating 39-cent cans of generic cat food in a cramped Phoenix apartment. She'd trusted Lincoln Savings with $65,000, every penny she'd saved over 42 years working night shifts at a hospital. A Lincoln salesperson promised her the bonds were safe as bank deposits. When Lincoln collapsed, she got back $2,000 from $65,000. And she wasn't alone. Over 23,000 elderly Americans had been systematically defrauded. $3.4 billion vanished. But here's what most people don't know. Lincoln Savings was just one domino. Between 1986 and 1995, over 1,000 savings and loan institutions collapsed across America. The total cost? $160 billion. In today's dollars, that's over $350 billion. And here's the part that should shock you. Over 1,000 bankers went to prison. 1,000 financial executives in handcuffs. Now compare that to 2008, a larger financial crisis, more money lost, and exactly one major banker served jail time. One. So what changed? Why did criminals face justice in the 1980s but walk free with million-dollar bonuses in 2008? This is the story America forgot, the last time Wall Street actually paid the price. This is Corruption Rewind. To understand how this happened, you need to understand what savings and loans were, and you need to understand the America of 1980. S&Ls were boring institutions, small, local banks that did one thing: take deposits from your community and loan that money out as mortgages to your neighbors. Simple, stable. By 1980, there were nearly 4,000 S&Ls holding over $600 billion in assets. They'd survived the Great Depression and helped build suburban America. Then Ronald Reagan won the presidency on a platform of deregulation. Government isn't the solution, Reagan said. Government is the problem. The S&L industry was struggling with high interest rates. They lobbied Congress hard for relief. In 1982, Congress passed the Garn-St. Germain Act. It removed most rules that had kept S&Ls boring and stable. Suddenly, S&Ls could invest in risky real estate, buy junk bonds, make speculative loans. The adults had left the room. But here's the critical part. These institutions were still insured by the federal government. Deposits guaranteed up to $100,000 by the Federal Savings and Loan Insurance Corporation, the FSLIC. Think about that. You hand someone massive amounts of money, tell them they can gamble however they want, and promise that if they lose, taxpayers will cover it. It's like giving a teenager your credit card and saying, do whatever you want, I'll pay the bill. What could go wrong? Edwin Gray was chairman of the Federal Home Loan Bank Board, basically the top referee who was supposed to stop fraud in the S&L industry. In 1983, just a year after deregulation, Gray started sounding the alarm. He saw what was happening. He tried to impose new regulations. The S&L industry fought back hard. They spent millions on lobbying, made massive campaign contributions, pressured Congress to shut Gray down. And it worked. Gray's funding was cut, his staff was reduced, his authority was undermined. But there was one name that would bring it all down, a man who would prove that when you remove the rules, predators don't just bend them, they shatter them completely. His name was Charles Keating. By 1984, the fraud had already begun. But on the surface, S&Ls looked healthier than ever. They were reporting record profits. Executives were getting rich. The trap was set, and millions of Americans were about to walk right into it. Charles Keating wasn't supposed to be a banker. He was a lawyer from Cincinnati who'd made money in real estate. In 1984, he bought Lincoln Savings and Loan in California for $51 million. At the time, Lincoln had about $1 billion in assets. Within 5 years, it would grow to over $5 billion. Here's the truth nobody saw coming. Every dollar was fraud. Keating didn't buy Lincoln to run a boring bank. He bought it to fund his real estate empire. Traditional S&Ls make money slowly. You pay depositors 5%, charge borrowers 7%, pocket the 2% difference. But Keating wanted fast money. So he took depositors' money and invested it in his own real estate projects, hotels in Arizona, luxury developments in the desert. He'd loan Lincoln's money to his own companies, which would buy properties from his other companies, creating the illusion of profits. Money moving in circles. On paper, it looked like Lincoln was printing cash. But these projects weren't making money, they were hemorrhaging it, which meant Keating needed more money, constantly. Enter the junk bonds. Think of junk bonds like betting on horses with broken legs. Occasionally they win, usually they don't. Lincoln started buying these by the billions. But here's what makes this criminal. Lincoln's branches started aggressively selling these junk bonds to elderly customers. Retirees would walk in to make a safe deposit, and salespeople would convince them to buy these bonds instead. One internal memo discovered later was shockingly explicit. Focus on customers over 65. They trust authority. They won't understand the risk. Use phrases like government-backed without saying FDIC insured directly. That memo alone would send 3 executives to federal prison. But Keating wasn't just a con man, he was politically connected, very connected. Between 1984 and 1989, Keating made over $1.3 million in political contributions. That's over $3 million in today's dollars. The money went to senators, congressmen, both parties. Keating didn't care about ideology, he cared about protection. And it worked. On April 2, 1987, 5 United States senators sat down with federal regulators in a Washington conference room. You know these names: John Glenn, the astronaut who orbited Earth; John McCain, the war hero who survived years of torture as a POW. These weren't corrupt politicians, these were American legends. And they were about to run interference for a criminal. The meeting was unprecedented. 5 senators in one room pressuring federal regulators on behalf of a single constituent, Charles Keating. Senator Dennis DeConcini opened. Mr. Keating is a respected Arizona businessman being unfairly targeted by overzealous regulators. Senator Alan Cranston, why is this investigation taking so long? Are you singling out Lincoln Savings? Senator John Glenn, are your examiners treating Lincoln differently than other institutions? Edwin Gray, the top federal regulator, later called it the most disturbing moment of my career. I felt I was being intimidated by some of the most powerful people in Washington. Here's what those senators didn't mention in that meeting. Senator Cranston had received $850,000 from Keating and his associates. Senator DeConcini, $55,000. Senator McCain, $112,000 plus private jet trips to Keating's vacation properties in the Bahamas. 5 days before this meeting, a federal examiner had submitted a 300-page report proving Lincoln was stealing $1 million per day. The report's conclusion was explicit: immediate seizure required to prevent further losses to depositors and taxpayers. Within 24 hours of the senators' meeting, that report was killed. The examination was transferred to another office in Texas. The seizure was delayed. For the next 2 years, Lincoln stayed open. $1 million per day times 730 days equals $730 million in additional theft. During those 2 years, 15,000 more people walked into Lincoln Savings with their life savings, all because 5 senators made a phone call. William Black was the federal examiner who documented the fraud. He later testified before Congress, "I watched 5 United States senators threaten federal regulators to protect a criminal. That's when I knew the system was broken." But while politicians ran interference for Keating, the math was becoming impossible to ignore. By late 1988, S&Ls were failing at an accelerating rate: 10 institutions per month, then 20, then 50. In December 1988, the General Accounting Office released a bombshell report. S&L losses could exceed $100 billion. The insurance fund was essentially insolvent. A massive taxpayer bailout was inevitable. George H.W. Bush was inaugurated in January 1989. One of his first classified briefings was on the S&L crisis. The numbers were worse than the public knew. Bush later recalled, "I realized we were facing the largest financial crisis since the Great Depression. And unlike the Depression, this wasn't caused by a market crash or economic forces. It was caused by criminals who'd bought political protection." Congressional testimony from 1989 tells the human story behind the numbers. These are real people who testified before the House Banking Committee. Their words are in the public record. A 73-year-old woman testified that she'd saved $200,000 over her lifetime, money from selling the home she and her late husband had built together, plus decades of careful saving from her work as a schoolteacher. A Lincoln Savings employee convinced her to move it all into bonds. Government insured, she was told, safe as deposits, better returns than CDs. When Lincoln collapsed, she lost everything. She testified before Congress in a wheelchair. She'd had a stroke 6 weeks after discovering her life savings were gone. Her doctor told her family the stroke was caused by the shock and stress. Her voice was slurred from the stroke, but her words were clear. "I thought these people were professionals. I thought they were honest. I taught children for 38 years to work hard, to save money, to trust people in authority. Charles Keating taught me that was foolish." She spent her remaining years in her daughter's basement, the very burden she'd spent 38 years trying to avoid becoming. She died in 1997, never financially recovering. Another victim testified that he'd lost $125,000, money saved for medical care. He was 71 years old with a heart condition that required expensive medication. After losing his savings, he had to choose between medication and food. He chose medication. He lost 40 pounds in 6 months. The First Baptist Church of Riverside testified they'd lost $2.3 million in building funds, money raised over decades from bake sales, fundraisers, bequests from deceased members. They'd planned to build a new sanctuary. Instead, they had to sell their existing building and rent space at a local school for Sunday services. There were thousands of these stories, real names, real testimony, real devastation. While they lost everything, Charles Keating lived in luxury bought with their money. He paid himself $1.2 million in salary plus millions more in bonuses. He owned a $4 million yacht. He had estates in Arizona, California, and the Bahamas. He flew in private jets. His office had a private elevator and was decorated with million-dollar artwork. Every dollar came from fraud. Every dollar came from elderly people like that 73-year-old teacher choosing between medication and food in their final years. April 14, 1989. Charles Keating is summoned to testify before the House Banking Committee. Congressman Henry Gonzalez, chairman of the committee, asks a simple question. Mr. Keating, where did the money go? Keating's response, I don't recall. He said it 53 times during his testimony. 53 times he claimed he couldn't remember basic facts about where billions of dollars went. Sitting behind him in the gallery were his victims. Elderly people, some in wheelchairs, who'd traveled to Washington to watch the man who'd stolen their life savings pretend he couldn't remember stealing it. That same day, federal regulators finally seized Lincoln Savings and Loan, 5 years too late. The final cost, $3.4 billion. But Lincoln was just the beginning of the avalanche. Throughout 1989 and 1990, S&Ls collapsed everywhere. Phoenix, Houston, Denver, Miami, Los Angeles, small towns across Kansas, Nebraska, Oklahoma. Vernon Savings in Texas collapsed after its CEO, Don Dixon, used depositors' money for beach houses, luxury cars, prostitutes listed on the payroll as consultants, and, I need you to hear this carefully, a $2 million Tyrannosaurus Rex skeleton for the bank lobby. Let me paint this picture. Vernon Savings had a full-size T-Rex fossil in their marble headquarters lobby. Not a replica, a real dinosaur skeleton worth $2 million. While 82-year-old retirees were eating cat food and choosing between medication and meals, the CEO was buying extinct animals for interior decoration. When FBI agents raided Vernon Savings, the first thing they photographed was the T-Rex. It became the symbol of the entire crisis, an extinct reptile standing guard over a crime scene. The dinosaur was eventually auctioned off to help pay back victims it sold for $1.2 million. Still not enough. Columbia Savings held $13 billion in assets, most of it in junk bonds. When the junk bond market collapsed in 1989, Columbia lost $2 billion in a single quarter. The CEO, Thomas Spiegel, had paid himself $9.4 million the year before. When Columbia failed, 8,000 employees lost their jobs overnight. Many had their retirement savings in Columbia stock, which became worthless. Spiegel walked away with his fortune intact. But here's what makes your blood boil. When regulators finally got inside Lincoln Savings after the seizure, the shredders had destroyed most of the evidence. Mountains of documents turned to confetti. But the shredders couldn't run fast enough. They missed one filing cabinet in a back office. Inside, handwritten sales training materials, specific scripts for targeting elderly customers, specific language to use, how to overcome their objections, how to make them think the bonds were federally insured without explicitly saying so. One training note said, don't correct them if they think it's FDIC insured. Just don't confirm it directly. Let them believe what they want to believe. Another memo outlined sales quotas. Each branch employee was expected to convert at least $500,000 per month in deposits into bond sales. Hit $1 million, get a $5,000 bonus. That one missed filing cabinet sent 3 executives to federal prison for fraud and conspiracy. George H.W. Bush signed the Financial Institutions Reform, Recovery, and Enforcement Act in August 1989. It created the Resolution Trust Corporation to liquidate failed S&Ls and allocated billions in taxpayer money for bailouts. But this bailout came with something different from 2008, accountability. The Department of Justice created a special S&L fraud task force. Hundreds of FBI agents were reassigned from other cases. Federal prosecutors in every district made it their top priority. Attorney General Dick Thornburgh held a press conference and announced, "We will pursue every criminal involved in this crisis. We will seize their assets. We will prosecute them to the fullest extent of the law, and we will put them in prison." And they did. Between 1989 and 1995, federal prosecutors filed over 5,500 criminal cases related to S&L fraud. Over 1,000 bankers and executives were convicted and sent to prison. Not fines, not settlements, not neither admit nor deny wrongdoing. Prison. Here's a stat that will blow your mind. Charles Keating spent $40 million on his legal defense. One criminal outspent the entire Justice Department's budget for all S&L prosecutions in 1989 and 1990 combined. The government's total budget for prosecuting over 1,000 criminals, $35 million. Keating alone, $40 million. And he still went to prison. November 1990, Charles Keating walks into federal court in handcuffs. Outside, protesters line the streets, many of them elderly victims holding signs. The judge sentences him to 12.5 years in federal prison. In his sentencing statement, the judge says, "Mr. Keating, you betrayed people who trusted you. You stole from the elderly and vulnerable. You corrupted public officials. You showed no remorse even when confronted with the suffering you caused. You are the worst kind of criminal, one who preys on the powerless while hiding behind respectability." Keating served nearly 5 years before being released on a legal technicality. But for those 5 years, the man who'd lived in luxury bought with stolen retirement savings wore a prison uniform and ate cafeteria food. And he wasn't alone. Michael Milken, the junk bond king who'd enabled much of the fraud, sentenced to 10 years and fined $600 million. Thomas Spiegel, Columbia Savings CEO, 3 years in federal prison. David Paul, SunTrust CEO in Miami, 11 years. He'd spent depositors' money on a $13 million yacht and a $7 million Rubens painting for his office. Don Dixon, Vernon Savings owner with the dinosaur, 23 years for bank fraud. Over 1,000 convictions, bank presidents, chief financial officers, board members, senior executives. It wasn't just foot soldiers who went to prison. Top executives faced real consequences. The Keating 5 scandal destroyed political careers. Senator Alan Cranston faced formal reprimand by the Senate Ethics Committee, a public condemnation by his peers. His political career was over. He didn't run for re-election. Senators DeConcini and Regal were also formally reprimanded. Both retired under pressure. Their careers effectively ended. McCain later called it the worst moment of my career and made campaign finance reform his signature issue for the rest of his time in the Senate. There were consequences, criminal and political. The system worked. The final cost of the S&L crisis, $160 billion in taxpayer bailouts, over $350 billion in today's dollars. But the 1989 reforms strengthened oversight significantly. Capital requirements were increased. Accounting standards were tightened. The FDIC took over deposit insurance with better funding. For a decade, it worked. The 1990s saw relative banking stability. The system had learned its lesson. Then something changed. In 1999, Congress repealed Glass-Steagall, the Depression-era law that had separated commercial banking from investment banking. The walls came down. Banks got bigger. Riskier behavior returned. Regulatory agencies were systematically defunded. And here's the pattern nobody wants you to see. In the 1980s, the financial industry spent approximately $1 billion on lobbying and campaign contributions over the decade. By 2008, they were spending $5 billion per year. In the 1980s, there were about 5,000 financial industry lobbyists in Washington. By 2008, there were 35,000. The pattern isn't that financial crime got more sophisticated. It's that criminals bought better protection. When you can outspend the Justice Department 100 to 1 on legal teams and political influence, you don't need to hide your crimes. You just need to make sure nobody prosecutes them. In 2007, Bear Stearns collapsed, then Lehman Brothers. The entire financial system teetered on the edge of total collapse. The 2008 crisis destroyed over $10 trillion in wealth. 8 million Americans lost their homes to foreclosure. Unemployment hit 10%. Millions saw their retirement savings cut in half. And one banker went to prison, Kareem Sarageldin of Credit Suisse. He served 30 months for hiding $100 million in losses. No American bank CEOs, no major executives, nobody from Lehman Brothers, Bear Stearns, Merrill Lynch, or AIG. Nobody from the firms that created fraudulent mortgage securities. Nobody from the ratings agencies that knowingly lied about risk. One conviction, compared to 1,000. William Black, the federal examiner who'd fought to expose Lincoln savings fraud, testified before Congress after 2008. We created a prosecution template in the 1980s that worked. We proved you could hold elite criminals accountable without destabilizing the financial system. And then we deliberately abandoned it. Not because it didn't work, because powerful people didn't want it to work. In 2013, Attorney General Eric Holder admitted in Senate testimony that some financial institutions were so large that it becomes difficult to prosecute them, because a criminal conviction could have negative implications for the national economy. We created a system where crime is rewarded as long as you steal enough. Here's a stat that will break your brain. If you stole $1,000, you'd go to prison for 1 to 3 years. If you stole $1 million, you'd go to prison for 5 to 10 years. Charles Keating stole $3.4 billion. By that ratio, he should have served 340,000 years. He served 5. Now do the math for 2008, when executives stole trillions and served 0 years. Right now, in December 2025, the conditions that created both crises are returning. Silicon Valley Bank collapsed in March 2023, the second largest bank failure in U.S. history. CEO Greg Becker sold $3 billion. $6 million in company stock 2 weeks before the collapse. He knew the bank was failing. He cashed out anyway. He has not been arrested. He has not been charged with insider trading or securities fraud. He gave interviews to Bloomberg and CNBC explaining what went wrong, like it was an unfortunate business miscalculation instead of a crime. In the 1980s, selling stock before a bank collapse you knew was coming, that would have been a federal case. You'd be in handcuffs within weeks. First Republic Bank failed in May 2023. Signature Bank collapsed in March 2023. Billions vanished overnight. How many executives have gone to prison? 0. And then they did something unbelievable. Congress is currently considering legislation to roll back even more banking regulations put in place after 2008. The same regulations that were supposed to prevent another crisis. The banks that failed in 2023, they're lobbying for fewer rules. The pattern is clear. We're not learning from history. We're actively forgetting it. 1,000 bankers in handcuffs in the 1980s, 1 banker in handcuffs in 2008, 0 bankers in handcuffs in 2023. The trajectory is obvious, and it's accelerating toward the next disaster. We made a choice in the 1980s to prioritize justice over protecting powerful institutions, to hold criminals accountable regardless of their wealth or political connections. We can make that choice again, but only if we remember, only if we demand it, only if we refuse to accept that some people are too big, too powerful, too systemically important to face consequences. Next week, I'm exposing how the 10 largest U.S. banks are using a legal loophole right now, in December 2025, to gamble with your deposits. The same loophole that destroyed Lincoln Savings. Except this time, it's not $3 billion at risk, it's $3 trillion. And Congress is about to make it fully legal. This affects your savings account, your checking account, your mortgage, your retirement, personally. 99% of Americans have no idea this is happening. The banks are counting on you not knowing until it's too late. Subscribe or you won't see this. The algorithm won't show you. Banks don't want you to know. 7 days. Don't miss it.